Hello everyone and welcome back. Well, everybody's freaking out right now, and rightfully so in some ways, over the tensions in Europe. But there's much more in play for markets across the world, including inflation and a whole bunch of other things. So in today's video, we'll be discussing everything to do with the stock, crypto and commodities markets, and we'll be talking about this peak volatility that we're going to see this week and what it means for you in the markets right now. Stay tuned. This is sure to be a big video, but also a great one. See you soon. Alright everyone, well the best place for us to start today's video is to discuss the geopolitical elephant in the room, and that is of course the tensions in Europe. Now we know on average that these tensions tend to work out with a negative correlation for the first day into a total drawdown average of negative 5%. We also know that it takes less than a month in terms of us to get to the bottom on average, and that number is a little bit skewed by the bottom one down here, but in general around those 10 to kind of 15 days is what you can expect. So is there more selling to come? Well, I guess the stats would say very much possible that that would happen. But the stats, if we could only take the geopolitical tensions into account for the US markets and our investment philosophy, obviously this is only talking about investment today, would be theoretically, you would, for lack of the better term, buy the invasion. Now, that doesn't mean that we're in that period of time though, because as we know, this isn't just a geopolitical tension. The market's kind of pinpointing and showing us technical signals that we'll be looking at in today's video that there might be a little bit more to come, and that each one of these rip rallies might be met by further selling demand. And it actually could play into the Fed's playbook. The Fed is in a tough situation, but we know that markets often overreact and look 12 to 18 months forward. So in the past history from 2001 all the way to 2020, was the market correct about interest rates and what was going to happen? The answer is no. They were pretty wrong. In fact, every time they thought rates were going up, they always thought they would be flatlining. Over here, the rates rose a lot faster than anyone expected. And over here, the market rose rates, but it turned out that they again thought it would flatline to slightly increase over time. Then they completely got it wrong during many times of economic crisis. So there's a clear disconnect between the Fed and the market from expectations. And the market is working on not that much information. When you think about it, the Fed doesn't really tell anybody anything anymore, or they tell each other a lot less. And this is a technique that was used by other chair people in terms of the big central banks around the world to keep the market guessing. And it could play into the best strategy the Fed has, which is to create volatility, to reduce the heat on the equity markets and of course the property markets right now, and to maintain the strong growth, because this is not an asset bubble from the perspective of if the market drops 20%, the Fed's going to start freaking out and everything's going to crash. It's not like that. We can maintain, or the US economy can maintain, a pullback here in the markets and move forward quite well with growth. So it could work into their book. And this has been sent round to many different central bankers and big investors and stuff, this idea, and it's becoming the new kind of thesis that a few big investors are starting to have in the markets. So here we have a chart of the current inflation and what's going on right now, and also the 2%, let's call it, trend that the Fed was meant to stick to and properly achieve over the last decade. Did they achieve it? Frankly, no. The Fed sucked at achieving this target of 2% inflation, and they superiorly underperformed it. So some bull case scenarios right now are we just returning back to the norm and we've seen an increased rate of inflation? Sure. But we're not in the danger zone yet. It's certainly a very interesting case and something that we are bringing up here. For another thesis on the bull side, usually most big crashes that you see over time tend to also be coinciding with an increased level of debt as a percentage of the GDP, especially the biggest debt in the world, which is household mortgage debt. We haven't currently seen that uptick from the US markets. Again, a bit of a positive here over the medium to longer term if you're looking at that in the markets. And obviously there's two ways to look at the market, a trader and an investor, and we're going to cover both today. Let's talk about US investor sentiment, currently quite negative. Some people would say, well, this is time to be greedy, but there could be a little bit less or a little bit more on the table in terms of short side than you might think. And we'll show in the charts, because the charts really are showing us the key levels here when we take a look at them. The other thing is that, remember, what happens after the first rate hike? Well, the stocks tend to do well. So remember, this is a sell the rumor, potential buy the fact. This is the strategy that we've talked about since the beginning here of 2022, that when Fed tends to rate hike, the market has already priced in something else. It tends to be wrong. So therefore the market turns around. You've got to think about it this perspective. In fact, 100% of the time, the markets have been positive after the rate hikes in the next 12 months. It's something to really think about. We also have seasonality of midterm election years. We know that there's weakness with a turnaround story coming off the back of March. Again, when is the Fed rate hike expected to occur? Here, if we have this geopolitical tension continue, how long did we expect it to go for? Maybe 10 to 14 days if it ends up being negative. And all of these kind of things point towards a bigger turnaround in the middle of the year if you can spot the signs in the markets. So when we're talking about markets and you're thinking about what are some of the signs of true economic recession, one of them is yield curve inversion. Now, we've talked about this in some other videos, but just remember, if you ever see the yield curve inverting, it's a canary in the coal mine. It's usually early, by possibly even 1 to 2 years. And you might say, well, that's pretty stupid, but it is a very, very, very big sign that something is wrong in the economy, and we have to expect some kind of very big correction moving forward. Now, we currently haven't seen that. Is it rising? Yes. Is it above? Not yet. And I think that's going to be something that we really want to be focusing on here for the rest of 2022. Another thing is when you're talking about buying the dips, when are some of the times to buy the dips? Well, sometimes you can correlate technical analysis with moving averages of all the stocks in the S&P 500. So this is the S&P 500 stocks currently above the 50-day moving average. And you'll notice that there's 33.4% of stocks are currently above the 50-day moving average. But what if that drops to these historical low points that we've seen in previous dips? What if we get down to an 8% or a 10% reading? Would that be an incredible buy the dip zone? The answer is historically yes. This zone here would be very, very phenomenal. So it's something that I would keep on the charts. Again, if the market gets too heated, often you get these top end levels, which is showing you might want to be a little bit cautious with buying here, or possibly even look to put in shorts. And one of these kind of indicators that many people do use in the markets. We'll talk about the VIX here. We expect this to, of course, come out and show some form of increase. If you were buying the VIX into, let's say, the Friday, you might be happy with the overall event, but the VIX may only just spike into 32. Of course, any closure above 32 would be the big key resistance. And I'm not sure how the VIX would trade here for the session, because it actually could be a buy the dip philosophy, at least initially, off all of this news. And we'll explain why when we take a look at the charts soon. We also have gold moving through here. Gold's trading at 1903. We'll know if you've been watching the videos for a while, or if you're a new subscriber, we've been following gold here for a little while, and we've obviously been very bullish on it in terms of sentiment. It is at a point of resistance, that 1910 level. We've been targeting this. It got to 1908, very, very close. And if it breaches through this level, the next logical conclusion for gold traders is going to be that 1960 resistance. So some examples for this week could be a breach, pullback, consolidation, move through, and you obviously to potentially pick up trades in this area with your own technical analysis systems. It's a key point of interest here for gold. There are a lot of other metals as well that are starting to improve. One of them is palladium. If you take a look here at palladium, it's been very technical recently with a great level of resistance, becoming support. We've had an inverse head and shoulders previously in terms of breakout. That was very similar to the gold. You've got an increased trade of volume, which is very huge. And if we go over here to the weekly, you'll notice there's been some big, strong buying coming through as well. So a very key resistance level. And palladium, some people actually have, one of the users in our Discord channel has talking about the fact that palladium sometimes is linked to semiconductors as well. If it's doing well, maybe semiconductors do poorly. I haven't checked that correlation, but it's an interesting one. And either way, this 24 kind of 20 zone, you can see how the price action here, if you're able to go to different markets, there's a lot of strength in these markets. And this one actually looks pretty good if it breaches through. Now, I'm on the record to a degree saying that US oil, I'm kind of done with it for the moment. And there's a few reasons why. I don't like trading these types of tensions with oil. You get up, down, and all around, huge spikes, 3% one way, 5% the other way. It's not necessary. It's exciting and exhilarating, but it's not necessarily a safe trade. So we've seen quite a few weakness signals come out of oil, and then it's kind of busted back through due to the tensions, obviously, in Europe, etc. We had a break of the trend line down. So we saw the trend line here go towards the downside, and then we have a bit of a pickup due to the tensions. I still think oil looks a little bit shaky at these levels, and from a price action standpoint, I call it neutral for now. But let's talk about the broad market. Let's talk about every single one of these major indicators that we're currently seeing and what we expect for the week ahead. Well, here is the industrial sector. Now, if I was to show you this chart, would you say that looks strong? A lot of people would say, oh, it's on the support. You're not wrong. It is. But if it breaches below this support, think about it as a channel. What is this? This is A. The distance of a technical channel should be B, which pushes you back down to around this $90 target, previous resistance. Now that's showing a bit more of a broad-based sell-off than we've been seeing recently. Remember, it's mostly been growth that's attacked on this market. Suddenly we would see industrials coming with it, and that would push the S&P 500 lower as well. The other thing is these rejection candles. This is what we've been seeing here in all of these markets. Huge rejection candles coming through, showing that each rip rally is being met by seller demand. Regardless of the geopolitical tensions, that tends to be more what I believe is Wall Street positioning themselves potentially for further shorting action. Now let's think about this as a resistance. If it ends up being a false break to the downside and it breaches past this level here, what's that going to do? It's going to take out a lot of stop losses, and you would have to be going bullish at this point. But I think the market has clearly shown its hand with these candles. If we go bullish and we close above there, bam, we're going to probably all-time highs. But if we end up going bearish here, we could very easily see a scenario where we're at $90 and the S&P 500 and Nasdaq are at much lower prices. And that all makes sense when we start looking at it together. So that's exhibit A, let's call it, industrials. They don't look good on a sector basis. Let's talk about Morgan Stanley. Now, this is just one bank, but what does that look like to you? If I put it on a daily chart, before you even go, pause the video, put it in the comments down below. What type of pattern could this potentially be? And hopefully a few of you got it right. Yes, it is a Wyckoff distribution, and it's got that max pain kind of concept up here, where the market has breached a level, not gone the distance, being A, which should be this equals this, and it has then come straight back down. Now, is it at support? Absolutely. But this is another part of the market that is on critical. This is, of course, a banking sector here, or a banking stock. And if this falls through, it could be a broader base sell-off again, not just growth that's really getting hammered here in the markets. Everything across the board starting to find some weakness, which could draw the S&P 500 a little bit lower. It's at critical, and a lot of the buyers or buy the dip scenario people will be trying to buy this level up. And I totally understand why. It's at that level. But again, something interesting. Let's now talk about the German 40. So this is the DAX. What does that look like? Yep, you'd be correct. Another Wyckoff distribution potential here. Max kind of pain coming through twice, extracting cash from, of course, investors, especially off the panic here, and then suddenly recouping that. People will be getting bullish again, and it's done a good job at probably trapping a lot of people into longs around this period. It's now closed below that on the weekly. Remember, this is a weekly pattern formation. It didn't take just a few days to happen. It took a while. It's like a premeditated sell-off that's occurring here. And here we have the rejection candles that have been present in not only the industrial sector, but also many other sectors within the market. They're all pointing towards this slightly negative narrative. So what happens now if the market rallies up? Well, if the market rallies, let's say here on the DAX to the 14,920-ish area, what do we expect to happen there? Well, you would expect sell the rip players to come in. And I think this is a big kind of discussion point between the bulls and the bears. There's two real main scenarios. One, if it comes up, we see further turnaround weakness, such as something like a lightning bolt on the smaller time frame, some turnaround, rejection, shooting star, whatever other particular bearish kind of situation we see here at the role reversal. Or we could see a scenario where it busts this and then comes back down, retests it, and gives many bull traders back in, effectively creating kind of like a reverse max pain. Now, we don't know how this scenario is going to work yet, But at this stage, it is presenting another story for the case of the potential of further bearishness. And if we take the trend line here of the distance of this move and extrapolate that out, funnily enough, it comes back to the Feb highs before the whole crisis, basically wiping off all of this money that's been pumped into the market on the DAX anyway, since the beginning of course, the crisis through the pandemic. So again, it starts to present an interesting picture. All these technicals are starting to lead together. You move over to the Nasdaq. Again, the Nasdaq showing weakness here. We've got very similar rejection, sell the rip style scenario. We're on a point that is incredibly critical. And if the market falls through here, of course, it could be looking a lot weaker. If we go over to the futures currently traded market, you'll notice that it's sold off actually underneath, but we don't have the real market volume with us yet. So we'll find out what happens here. But I could very easily see like some type of scenario where maybe it tries to rip up, hits one of these levels in this 14,000, 13,900 zone, and then finds some resistance sellers. So finds basically people very willing to try to short it in this zone. I think that's what a lot of people will be looking at. If we breach past, let's say here, and if we go up and we don't short this zone and we keep going up, is that going to present a potential bullish case scenario? I think for day traders and scalpers, yeah, it certainly could. And this is a great, again, breakdown here of the markets. The Nasdaq is showing that it's possibly looking quite weak with a series of lower highs. So that is weakness in this market. Every rally has been less and less and less. And this is the real market that's come under the most fire. But let's go over to the big one, the SP 500. If you were going to check any market, this is the one to check. Again, the weekly, it looks crappy. I mean, frankly, that's a tweezer kind of rejection here. And we've already stated, like a lot of people have come up with, that this could be a massive head and shoulders. Left shoulder, head, right shoulder. You take the distance from that head and shoulders to what people expect. What's it pointing towards? It's pointing towards that 3,800 level. So if you can go down to the 3,800 level, what is that in terms of a pullback in the markets? Well, it's around 20% from top to bottom. So basically right on what is technically called a bear market. If the Fed was able to achieve this, it might actually solve a big portion of their concerns in the market to do with inflation. They'd be getting the asset bubble down a little bit. They'd be allowing the growth to then resume in the markets, and it could be a very big positive. So just remember, while the market might look more fearful, and even if it does start to short off, what is your scenarios? Are your scenarios 50% down? Are your scenarios 60% down? The whole economy is stuffed? Or do you have a plan if these things were to eventuate? And at the moment, the market is starting to come up with a bit of a bear thesis, at least in the current technical analysis terms. So let's look again at the US 500 futures. Let's now go to the daily chart here and think about where all of the current daily rallies have happened. Well, they've all happened around this 43.20 zone. So let's say again, the futures managed to rally. We see that buy the dip come the Tuesday market open. What do you think might happen here? I think the bears will try to take control of the market at this point. It's an interesting area, or around this area is interesting. And really you're looking for signs that might allow you back into the bear position. And if it does end up just going bam, and you think, oh damn, that thing's rallying, then what you're looking for all of a sudden is, of course, the bull case. This is a day-by-day scenario. We haven't seen full recovery or anything like that, but we have certainly seen a lot of speculation here towards the negative side from the price action. So it's a day-by-day. Make sure that you're very nimble and fast in these markets. Scalp, day trade, certainly things. Swing traders, not doing so well right now. We managed to get a very good level last week, which of course was this double top and the role reversal. It sold into the big important support zone, and now we're playing with fire. Basically, if we get through these big levels, especially the weekly 50 exponential moving average, which is right here, right now, I'll show you it here on the SPX, there it is. If we close below that, history will tell us that in the past, it's quite rare, we tend to get further selling. So when that occurs, the old 50, when it breaches, is not very good for the market. So just remember, 50 exponential moving average, we're on point critical here, and there's a lot to be concerned about in the markets from that aspect. But again, huge opportunity potentially in the future. Let's move over to Bitcoin markets. They're moving in line with The rest, basically, they're following whatever the Nasdaq does. If the Nasdaq weakens, we're seeing Bitcoin move down, and that pulling every other one of the cryptos down as well. Alts are just getting obliterated. I mean, some alts are down 80% already. And this is unfortunately what happens in crypto winters, and interest rates weren't kind to them in 2018. And I guess they're not kind to them this year in 2022. So we'll find out how it plays out. But again, rejection candle. We could be moving right back down to this $30,000 level very quickly here. I'm not seeing any signs currently of recovery in Bitcoin, but anything can happen over the next 24 hours. So be nimble and fast in these markets. And of course, if you're trading, have a stop loss, have a take profit, and have your entry point. But always have a plan before you get in, because it can be quite dangerous. Just a quick reminder for anyone that wants to follow us, come over to our Twitter. That's FX Evolution on Twitter. Come and join us. I posted this one over the Monday session, which was a nice little potential area for short. It ended up shorting, which was pretty nice. So come and follow us over there, and always join us in the Discord community, whether you join the private or the public. There's some amazing people in there sharing their charts and really taking what they've learned about the markets and giving you some great opinions. We've got some fantastic major contributors on there, and a lot of them have some great ideas. So see you soon. Thanks so much for watching, and we'll catch you in the next video. Bye for now.